Good evening. You've tuned into ET now, and this is the Money Show. And this week, all week we're celebrating Diwali, and today as well we will stick to that exciting theme. Here's what's on the show today. What we've planned for our viewers. First up, how to go about investing in Samvat 2077. The big question that's looming large. We'll help you address that with our experts. And finally, there's financial lessons for the coming Samvat, something that we have been talking about all this while, and we'll get you a host of experts to tell you how to make your Diwali more festive and more sparkling, more prosperous. First up in the segment, let me introduce you to the guests. First up, you have Gaurav Mashruwala. He's a certified financial planner and author of Yogic Wealth. And you also have Rajesh Cheruvu. He's the CIO at Validus Wealth Zoom. Let's understand with both of them how one can go about celebrating the Samvat that's here to come 2077 and how to make the most of it as far as returns are concerned. Let me take it across to Gaurav first. Gaurav, it's been a very eventful Samvat for all the investors, the one that's about to end. What were the most important lessons according to you?
Number one, we have always recommended to maintain contingency fund. Now, those who maintained were really better off. Those who didn't, they struggled. We normally say about 3 to 4 months of your monthly expenses. Whether people had job loss, pay cuts, regular income, or in some cases, erratic income, all those who had contingency funds sailed through. Number two, have health insurance. People who lost jobs and had health cover from employers were suddenly out of job and health cover. And the third most important point is either no loan or very less, because mentally it has a lot of stress. So those who did not have EMI burden were much better off vis-a-vis those who had that.
All right, gentlemen, request you to be with us. I'll quickly address the numbers delivered by Aisha for the quarter gone by really quick. You have a consolidated PAT figure coming in at 335 crores versus 369. So it's a flattish bottom line growth and largely in line with what we were expecting as well, according to our poll of 340 crore rupees. Consolidated revenue came in at... Oh wait, I think that's the wrong figure that I'm reading from. Consolidated PAT for Eicher Motors has come in at 343 crores versus 572.7 crores. As far as the revenue is concerned, 2,133.6 versus 2,192.5 crores. I would say revenue is also largely in line, maybe 100 crore rupees beat as far as the consolidated performance goes. So these are the headline numbers that we have so far for Eicher Motors. EBITDA at 471 crores and consolidated margins came in at 22.1 crores, slightly better than what we were expecting. ET Now poll was indicating 21.5. What they delivered is 22.1% for the quarter gone by. So I would say it's a largely inline set. Margins definitely have been better than expected. Management is not doing a con call really this time around. So let's see how and what their commentary has been exactly. The press release is also not on the exchanges yet, but I would say it's an inline set. Moving back on with our guests for the Money Show and the Diwali theme that we've been talking about. Rajesh is also with us. Rajesh, Gaurav was just talking about the key takeaways and the key lessons learned in the Samvat that's just about to end. What were your big observations? And of course, this has been a year, almost a black swan sort of in a year. What will be your key highlights and key takeaways from this Samvat?
Yeah. You're absolutely right, and Gaurav is also actually Gaurav's suggestion is also absolutely true. This is unusual pandemic, unusual event in our lifetime. None of us would have seen in our lifetime. Uh, based on the history, between 1918 and 1923, similar kind of magnitude of crisis has been seen. So once in 100 years, we have been actually hearing this kind of actually situation. Uh, Given this, having a buffer, permanent buffer, having 4 months to meet the 4 months eventual expenditure, etc. That's a welcome suggestion. But in general, whenever someone is going for a mortgage loan, general suggestion we give it to them is to have at least a 6 months buffer. If there is any displacement or disruption in their income flows or cash flows, they should be able to meet their mortgage payouts. Over and above that, I think that this particular buffer, but once in a 100 years or once in 15 years kind of event, if we keep the buffer, how much opportunity loss, how much opportunity cost it could have, that is a question mark. So that is where what I would think and what we suggest in general is to have investment portfolios to be liquid between 50 to 70%. It means I think there cannot be a closed-ended products or exit load structures up to 50 to 70% of the portfolio irrespective of the asset class, whether it is equity, debt, or gold, or alternatives. It can at least 50 to 70% of the portfolio should be kept in liquid assets. And over and above that, most important thing to highlight in this, I think, based on this pandemic and this situation, is one should have adequate sum assured of health insurance, and over and above that, super top up. So that makes actually economics really well, and a combination of it, base plan and super top up of about, for a 4-member family, of about 50 lakhs to 1 crore kind of policy is a must. Actually, given the kind of healthcare expenses and unplanned expenditures we have seen in the recent times.
All right. Gaurav, coming back to you, let's look ahead. What lies in the news somewhat? It's often a great point to also review investments, right? What has this pandemic taught us about the constituents of a portfolio and their significance in one's overall holdings?
A couple of things. One is most important, I have been always recommending that husband and wife go on financial date, which means every 3 months spend 2 hours jointly reviewing your portfolio and all finances. Pandemic has taught us that again, let family be aware of it. Apart from that, emergency fund, health insurance, loan is what I already mentioned. But another important thing is ensure your investments are linked to your financial goals. Now, when husband and wife sit together, or the entire family, or two partners, I'm not getting into married, unmarried couple or something, they should also review their financial goals and make suitable modification in their portfolio.
Rajesh, looking forward, how can one sort of manage their portfolio better going forward in the new Samvat? If one is already started saving and investing, and especially the ones who are yet to start sort of meaningfully putting aside their savings into the markets and into various instruments?
To start, there are, as you said, there are two set of investors. One is, I think, first-time investor. Other one is, I think, already seasoned investor or already exposed investor to the markets. So first set of investor, like I think, who is coming to the market first time, he should have assessment with respect to the kind of return expectations he is having, and the kind of risk he can take, and the horizon he's looking at it to meet the cash flow requirements from his life goals or wealth creation goals. So once that is done, that is as an outcome, they would tend to have asset allocation outlay. So based on that, I think routes to market, what kind of routes to market? They could look at it whether it is mutual funds or direct securities. Then within that, how they ladder up the risk allocation in the portfolio. That's how they need to go. They have to go through that journey very structured way rather than they have to go a bit structured way. That is very clear. So having discipline from the beginning is most important thing for a first time investor. The seasoned investor also actually, as time to time they have to market being a dynamic environment. They should not marry to a particular approach or the particular style, because with the changing style, with the changing market conditions and changing market outlook and macro outlook, they also have to actually change their approach in terms of certain times. I think they need to be dynamic in terms of positioning the portfolio safer. Certain times that they may actually accelerate the gear and they need to move faster to meet the return expectations. So that I think as actually they gain the comfort and as they gain confidence, and the routes to market also possibly they could change. As I said earlier, they should start with mutual fund, then they should move to direct securities, then as they gain confidence and comfort, should move to PMS AF structures, or then I think in terms of risk building and risk budgeting also, start with a large cap, then you should move to multi-cap, mid-cap, small cap, micro cap, and then pipe funds, etc. That's how I think they have to ladder. And as they gain maturity, investors have to do that way. And active profit booking and active asset allocation, rebalancing from time to time. As assets, for example, equities outperform for about 6, 8, 9 months. I think they against the target allocation of 50%, it might go to 60%. So they need to actually bring it back to 50% with the help of their advisor. And or should they do it or should they wait? So that's where I think expert advice and advice is very important. That will help them to remove their personal biases and behavioral biases. Biggest enemy to the investor in the marketplace is behavioral biases. So to overcome that, third person who doesn't have actually any such influences can help them to overcome such biases. That is the approach I think both startup investor or the seasoned investor, the first time investor as well the seasoned investor could actually adopt.
Okay. Back to you, Gaurav. Let's talk about diversification across asset classes. Its importance has obviously been proven with the rally in gold. How do you recommend investors invest across the various asset classes in the coming year?
A very important question. Always look within. Look at your financial requirements and build a portfolio. Don't look outside. So for any of your financial requirements in 2 to 3 years, choose a debt instrument. It could be in terms of a debt fund, FD, post office scheme, whatever suits you. Anything between 3 to say 5, 6 years should be combination of debt and equity. Again, it could be funds, it could be direct. And anything greater than 7 years equity as an asset class, again, direct or through a mutual fund. Now, apart from this, gold should always be in your portfolio because gold acts as a balancing factor. Only thing is be careful when you invest in gold, if it's for physical consumption or if it's for, precious gold, buy physical coins, biscuits. If it's for investments, it could be gold bond, ETF, etc. Now, this entire thing should be done keeping in mind your goals. It has nothing to do with outside conditions. And let me give an example that will help. Suppose if my son or daughter was to go for higher education in 6 months' time, I won't tell them gold is rising or equity is rising, defer your education. Let me make some money. If GST on airfare goes up, and under normal circumstances, if family is going to go on vacation, they won't cancel that trip. If there is marriage in the family and equity market falls, we don't say don't get married. Our funds requirements are not linked to outside conditions. So please don't make any changes in your portfolio based on outside conditions.
All right. Okay. Point taken, Rajesh. Talk to us about how one should go about investing in instruments other than the equity markets, debt, it could be gold, it could be real estate, etc. Are there any tips that you'd like to give our viewers that they should keep in mind before looking at commodities and real estate space, perhaps?
Commodities as a segment from post 2011, they have not seen the recovery. Most of the commodities, even after last 4 months rally, they're still 40 to 50% discount to 2011 highs. So our sense is, I think it will take more time. It might take a longer time to recover commodities because a globally commodity cycle has taken head because of the Chinese slowdown, economic slowdown. So within commodities, I think we are only one commodity we are quite optimistic is gold. Gold, as Gaurav has mentioned, we do suggest investors to have at any given point of time a part of their portfolio. But time to time, you might go underweight and you might go overweight. On an average, we suggest people to have 5% allocation in gold. And last 2 years, we have taken overweight position. So up to 8% we have taken it. That has really worked. At times, but a larger perception issue or larger behavioral bias, like as I mentioned earlier, another behavioral bias is people think gold performs only in bad times. But gold performs in both bull phase as well bear phase, both in growth environment or as well in recession environment. So with growth, I think inflation also start catching up. It is also considered as hedge against inflation globally. And that is another asset class. Gold is another asset class for investors to buy it in dollar terms. You are paying it in rupee, but it is a dollar denominated asset. That is for sure investors should have that as part of the portfolio. But what mode and what method? That is the most confusing. That is most of the investors are confused with. We suggest them to have out of 5%, 50% through ETF and 50% through sovereign gold bond route, so that I think 50% of it is liquid at any given point of time, so that you can take underweight position. And the other question you have asked about the real estate. The real estate, unlike global markets, we don't have liquid real estate as an asset class as part of the financial investments. Most recently, we have seen two REITs got listed. Both of them have given actually very strong returns. And REITs is one good asset class I think investors could consider. Globally, it is considered as part of the alternative asset class. So as part of the alternative allocation, investors could consider REITs into allocation between 4 to 6% kind of yield they keep generating. And tax efficiency is much superior compared to dividend yielding stocks or fixed income. So that is with respect, I think real estate, instead of buying direct real estate stocks or real estate funds, and the REITs offer a much better, much superior opportunity to participate in real estate story. And that's more largely, I think these REITs are commercial real estate and rental yielding stories. So you will have a sustainable cash flows and as well, I think capital appreciation from time to time.
All right. On that note, gentlemen, Gaurav as well as Rajesh, will let you go. Thank you so much once again for joining in and for helping our viewers out plan their portfolio ahead of the new Samvat. Wish you both a very happy Diwali in advance. Slipping into a break here, plenty more on the other side. Stay tuned.